So today we're going to talk about how we actually go about planning by taking information that has already happened and how do we go about forecasting what is going to happen or what we expect to happen the following year or next week in multiple subsequent years. Okay, so what we're going to be speaking about today is a method of forecasting called the percentage of sales method. And that basically just simply means that as our sales grow by a certain rate, all of the underlying expenses that are required in order to support that sales growth also go up by the same percentage. Okay. And then we'll look at something called external financing needed, or EFN, right? Meaning where on the balance sheet are we out of balance? And so how much debt or how much equity do we need to go out and find in order to force the balance sheet to balance? We'll talk about two different types of growth rates, an internal growth rate and a sustainable growth rate, and what those mean, and whether or not your forecast growth rate is achievable or sustainable based upon where that projection falls in between, below, or above the internal or sustainable growth rate. And then we'll briefly talk about some of the problems when we plan for growth. Because we're projecting an unknown. We're doing our best to look into our crystal ball and project what the next year or even 5 years or even 10 years might look like in terms of the firm's revenue growth. So I'll briefly talk a little bit about what financial planning is and how we go about the capital budgeting process, because what this is exactly what firms do every single year. Every year, towards the end of the year, we go through a budgeting process for the following year where managers are asked to provide their budgets. And we have to look at what the expenses are, what the salaries are, how much revenue we're going to bring in the door, and we have to provide to senior management a budget for the following year. And we're going to take a look at one method that we talked about called the percentage of sales. And I'll show you two different ways of doing it. One is gives you a little more visibility into the actual line item ratio as a percentage of sales. And one is kind of the quick and dirty way to do it. I'll show you both. So when we think about the elements of the financial planning process or the capital budgeting process, all right, we're sometimes talking about whether or not we need to invest in new assets for the firm. Okay, do we have enough capacity within our existing assets to support the projected sales growth? And if we do, maybe we don't have to invest in any new assets. But if we're already running at 100% capacity and we want to grow by 5%, then we probably are going to have to invest in some fixed assets in order to allow for that utilization to drop so that we have room to grow. Okay. Well, how are we going to pay for these projects? All right, so how much financial leverage are we going to employ? Meaning debt versus equity. Are we going to finance this with a bank, or are we going to finance this through our shareholders? And just like we talked about last week, are we going to pay money to our shareholders in the form of a dividend? So what kind of dividend policy, all right, are we going to implement for our firm? And is it going to be consistent from one year to the next? It's a very important decision to make. And then finally, our liquidity requirements. Okay, what are the net working capital needs of the business? Once we decide we're going to do this basket of projects or we're going to grow the business by a certain rate, are there implications on our net working capital needs for the business in order to support that additional growth? So when we talk about something called the planning horizon or time horizon, we're really looking at splitting up our forecasting into 3 different types of buckets, right? This lists 2 typically you'll see three. So you've got a short-term bucket, which is basically forecasting the next year, okay, the next 12 months worth of operating activity, right? Then you've got more of kind of that intermediate term planning. We call it strategic planning. So it's our 5-year plan. And then based upon what we do 10-year pro formas, which you'll be doing in a couple of weeks, to determine whether or not a project is viable or not, then we get into more long-term planning, which is 10, anywhere from 5 to 10 to 15 years down the road. Right? So when we think about how firms go about allocating capital, right, they do it on an aggregated basis, meaning we essentially take all these projects that we've kind of decided that we're going to do, and we roll them all up with all of the financial data that goes along with each of the projects. We aggregate everything and we call it one major project. And in aggregate, that one major project will cost X and it will deliver Y in terms of today's dollars of cash flow. And it has, Z rate of return. Okay, so all the different projects have their own financial data associated with it, and then it all gets rolled up and aggregated at the top level. Okay. And then we have to start making some assumptions, right? I mean, we don't know what's going to happen next year or 2 years or 5 years down the road, but we have to make some assumptions around the business, right? And they have to be realistic. Okay, you can't project a 20% growth rate if you're in a mature, saturated market. It's just not going to happen. Okay, 1%, 2%, that's feasible. All right, if you're in a high growth market space, then a 20, 30% growth rate may not be that bad. Right, it's possible that you could have a 20 or a 30% growth rate in a high growth environment. So the point about assumptions is they have to be realistic and defendable, right? And then you have to stress test it. So you need to run different scenarios with different costs of capital, different rates of return, different sensitivities to economic factors. If you work for a chemical company, the price of oil in the marketplace is a huge assumption. And so we'll run hundreds of simulations based upon different prices of oil to see what happens to stress test the business decisions. And then finally, you kind of want to have a worst case, an expected case / normal case, and then a best case. We call that the bear case, the average case, and the bull case. So what this does is it allows the management team to get an idea of how their decisions for various projects affect the other projects that are going on. Okay, so those interactions between the projects gives management a way for exploring what other opportunities might exist for the money that they're looking at deploying into their business. Okay. And going through the budgeting process gives the management team, both at the granular level and at the top level of an organization, the ability to see where the holes might be, right? To see where the stress points are going to be within the budget. Okay. If we don't go through the budgeting process and we simply just let things happen as they may, we can sometimes get ourselves into a world of hurt pretty quickly sometimes, right? So by going through this whole process, it basically ensures that we're deploying our capital in a very feasible and consistent manner, right? And it helps management make sure that the goals that they're trying to accomplish can be accomplished within the parameters that they've established. So when we talk about some terminology here, so we have something called a sales forecast, right? And we can look at it from a top-down perspective where management says to the sales force, I expect you to grow by 5% next year. Or we can look at it from the bottoms up where we start with the salespeople and we ask them to look at their business and we say, what is a realistic expectation for growth from you in your territory? So we have a sales forecast, which is exactly what it sounds like. It is a forecast for what our revenues are going to be for the following year. Okay, and it's usually in terms of a growth rate in percentage terms. So 5% growth or 10% growth based on what we did the prior year. And then we have what we call pro forma statements, right? How we go about setting up the plan using the projected growth rate and developing what an estimated income statement and balance sheet and cash flow statement are for the next year. Okay, so we're looking ahead to the future year. We're forecasting what next year is going to look like using a sales forecast as our primary metric. When we do that, all right, it gives us an idea of, do we need any new assets to help support that growth? Do we need to go to the debt markets to finance some of these projects? Can we finance some of these projects out of the equity side of our balance sheet? Okay, and once we've put all of these things in place, the balance sheet is not going to balance. Okay, it's just not, because we haven't actually done anything next year. We're just forecasting next year. So once we've got all these assumptions put in place, we're going to have to decide, where do we go about plugging the balance sheet in order to make it balance? All right. And typically there's two places where we do it. We'll do it either with the type of financing that we're going to do, either long-term debt, okay, or with common stock, okay, or through dividend payments. Maybe we cut back on our dividend payment to allow more to flow through to retained earnings to help balance the right side of the balance sheet. Okay. And then we've got other assumptions that we have to make, like inflation costs, the cost of fuel if you're working in the chemical business or in an industry that relies on gas or petroleum products. Okay, so the plug variable is something that we're going to focus on today, as well as the forecast and the pro forma statements. So let's take a look at this gourmet coffee company. Okay, and for their balance sheet, and this is obviously super simple, okay, but it's okay, we can work with it. Okay, they've got $1,000 in assets, they've got $400 in debt, $600 in equity, so the right side and the left side balance on $1,000. Okay, their income statement for 2018 had revenues of $2,000 and they had costs of $1,600, so their net income was $400. Right, so you can already see this is a super simplistic example, but it's important because we're going to build on this as we go through the rest of the lecture today. So keep these numbers in mind. All right, so when we're developing a pro forma statement, right, a projection, okay, of what the next year is going to look like, in this example, our assumptions are the following. Revenue is going to grow at 15% based on last year's number. Everything that's tied to sales, okay, is going to keep their current relationship, right, meaning that they're optimal. So if sales go up by 15%, everything else goes up by 15%. So everything will move up in the same rate, and that will be our projection for next year. So when we do that, okay, we can see that our revenues moved up to 2,300, and I have somewhere in here I had my thing. So they started at 2,000. All right, so they moved up by 15% to 2,300. Our costs were 1,600, and they moved up by 15% to 1,840. Therefore, our net income, revenues minus cost, 460, naturally also moved up by 15%. Right? Now, this is a super simple example because, as you know from the income statement, right, there's other items that are in here that are not cash items, right? Depreciation. Does depreciation grow by sales? Not necessarily, right? If you don't have to buy any new fixed assets to grow your business, then depreciation really has no relationship at all to sales, right? If you're not having to buy new fixed assets. If you are having to buy new fixed assets, then yeah, there is some relationship to sales. But then again, you get to depreciate those assets over a 10-year, 15, 20-year period of time. So it's not going to be the 15% increase that you would see on the other items within the income statement. Okay, so we're going to go through that in further detail here in a few minutes within Excel. But nonetheless, from a very basic example, the percentage of sales method applies. Sales moved up by 15%, everything else moved up by 15% on the income statement. Anything that is tied to or correlates to sales will move up by that growth rate. Okay. Now switching over to the balance sheet here. I need to change my page around. Okay. If we look at two different cases here, all right, where we have to have a plug variable, right, because if we go, I'm going to go ahead and go over to Excel. That way, just make things a little bit easier. Okay. So if we're in Excel, okay, and we're going to build the pro forma in Excel for the income statement. All right, I just brought the numbers over from this gourmet coffee. It's pretty straightforward how we do it within Excel, and it'll save yourself a lot of time if you understand how to use Excel properly. If we want to project 2019 revenues with a 15% growth over 2018, it's simply nothing more than what we did in 2018 times 1 plus whatever our growth rate is. Okay, that's it. Okay. And then the same thing applies with our costs. Costs are going to go up the same rate that our sales are going to go up. So equals sales times 1 plus our growth rate. Okay, and we get that, and then we can do our net income of revenues minus expenses. Okay, so we can see that the percent change between 2019 and 2018 is 15%. Okay, so we've got a check. So we know that we did our math right. We know that the percentage of sales method works, and we know that down the line, the things that were associated with the rise in sales were altered by 15%. All right, so we're good to go on that. All right. Now let's talk about on the balance sheet side, okay, what things are going to go up in terms of our balance sheet, okay? So if we take our assets, all right, they started off as 1,000, okay? If we go up by 15%, we're talking about taking those to 1,150, right? So those will go up to 1,150, okay? So now we know that our assets side is a total of $1,150, right? If we're going to use dividends as the plug, all right, then if our debt also goes up by 15%, okay, so we go from 400 to 460, okay, because we started with 400, we go up by 15%, that takes us to 460, okay. Then we also now see that we're still out of balance, okay. So we now know that our equity has to be the plug. So what's the difference between the asset side and the liabilities side right now? So 1,150 minus the 460, okay, is 690. So we know that equity has to be 690 in order to force the balance. Okay. Now, this is where I'm going to test your brain. If we know that equity, okay, is comprised of retained earnings, right? Between 2018 and 2019, okay, what should our projected addition to retained earnings be?
Would it be 690?
It would not be 690. So if we're not paying any dividends, let's put it this way, a different way. If we're not paying dividends in 2019, what should our 2019 projected equity be if we started 2019 with 600, okay, and we made 460 in net income? If we're not paying dividends, what should our equity be without paying any dividends for 2019? What should that number technically be? Remember, net income equals dividends paid plus additions to retained earnings, right? So if we were to do the math correct, one would think that, okay, if we're not paying dividends, then equity should be what we started with at the beginning of the year, right? Plus whatever we did during the year operationally, okay? So the flow of net income into retained earnings adds to retained earnings. However, now we're out of balance, right? So if we're using dividends as the plug, it means that we have to pay $370 in dividends in order to force the balance, okay? And if we pay $370 in dividends, now we're in balance, okay? I'm going to stop there and ask questions, ask for questions. This is a very important relationship that you need to understand.
Can you do that again so I can just see one more time how
Sure.
you got that?
Yeah. So if we're going to use dividends as the plug, right? So let's just start here. All right. We took assets up by 15%. We took debt up by 15%. Okay.
Okay.
Based upon the growth rate. We got nothing in equity, right?
Yep.
Okay. Which means that equity has to be the plug. Equity must be whatever it is going to be in order to force the balance to be correct, because both sides have to balance, okay? So that's step one of learning. So we're $690 off for balance, right? So we force equity to be 690, right? Now we're in balance, great. But what does that 690 mean, okay? So when we look at retained earnings, in 2018, right, we started with 600. We ended 2018 with 600, right? And then we added to retained earnings within our operations estimate for 2019, right? And how much did we add to retained earnings if we didn't pay any dividends? How much did we add for 2019?
The 460?
The 460, okay? So we got 460, right? So theoretically, right, our projected 2019 equity okay, should be what we started the year off in retained earnings plus what we put in there, right? So it should be that. But now we already did the math. We said equity is going to be our plug. So we know that equity has got to be 690. So now the question is, of this 460, how much did we pay in dividends? Because remember, net income equals dividends paid plus addition to retained earnings. So if we know that the equity has got to be 690, we know that the projected 2019 equity with or retained earnings without any dividends paid was 1060, but we know it's got to be 690. We know it's that minus the 690. So we know we had to pay $370 out in dividends, right? Because if we do that, okay, of the 460, we paid 370. Addition to retained earnings, right? Difference between 460 and what we paid out is 90. There you go. See, and we just balanced. So the 90 added to the 600 gave us the 690. So therefore we know we had to pay $370 out in dividends.
Okay, thank you.
Questions? Anybody have questions about that? Okay, so understanding that flow, when we're making projections, the first step is just to get what we need plugged in, okay? And then it's gonna be out of balance. And then we have to decide where we're going to plug the variable, whether it's gonna be through debt or equity, okay? Common stock or retained earnings or changing our dividend policy, okay? So when we have our check-in exam on Thursday, okay, I'll tell you what the plug needs to be. All right, I'm not going to ask you to pick one, but you need to understand that the management has different levers to use in order to force the balance on the balance sheet to figure out whether or not they're going to take on more debt or they're going to use equity for that external financing required. Okay. So when we talk about the percentage of sales approach in a little more detail, there are going to be some things on the income statement and some things on the balance sheet that will naturally vary with sales and some that don't. Okay. So on the income statement side, most of the time is fairly consistent. All right. Costs are going to vary with sales. Okay, so as sales move up, cost of goods is going to move up similarly. Supporting costs are going to move up similarly. Doesn't always work out that way, but from a forecasting standpoint, that's typically how we go about budgeting. Okay, so once we get down to EBITDA, okay, everything above EBITDA is going to float based upon that percentage of sales. Okay, once you get below EBITDA, and we start talking about depreciation and interest that we pay to our creditors, and then the taxes that get calculated based upon the EBT, you know, those items, you know, they're not linear with sales growth, right? So just because sales move up by 5% doesn't mean you pay 5% more in taxes, okay? Because you could have more depreciation or you could have paid more out in interest that impacts EBT, and EBT is what taxes get calculated on. So from everything from EBITDA and above, right, is going to vary with sales for the purposes of this class. If sales move up by 5%, everything EBITDA and above goes up by 5%. Okay. Dividends, they don't vary with sales. That's a management decision. Okay, if we keep a constant payout ratio, meaning the dollars of dividends that we pay out divided by our net income equals payout ratio. If we keep a constant payout ratio and sales go up, then we should see more dividends getting paid out to shareholders. But again, if sales go up by 5%, that does not translate into an additional 5% going out to shareholders because you're dealing with a distribution of net income, which has depreciation and interest and taxes factored into it. So when you're building these pro forma estimates, you'll increase everything EBITDA and above by 5%, and then do the regular math below that to get down to net income. And we've got a big example coming up here on that. On the balance sheet, for all intents and purposes, on the assets side, we're going to move all the assets up by whatever sales goes up by. So if sales go up by 15%, then cash is going to go up by 15, AR is going to go up by 15, inventory is going to go up by 15, and net fixed assets are going to go up by 15. So the entire left-hand side of the balance sheet is going to go up by sales. Why is that? Well, if we sell more, we should probably have more inventory on hand. We will probably have more money to collect, and we will probably have more cash on hand. And if we're selling more, we probably have to buy more fixed assets. Not all the time, we'll get to that. But so the whole left-hand side of the balance sheet would naturally move up with that percentage of sales increase. With that said, on the right-hand side, the liabilities and equity side, there's really only one item that can be directly correlated to an increase in sales. Anybody want to take a guess as to what that is? There's really only one item on the right-hand side of the balance sheet that has a pretty much a direct correlation to sales.
Is it equity?
Not equity, because that's kind of a plug, right? That's a lever that management has to figure out how they're going to finance the necessary assets that they might need to grow the business. So that's not going to vary directly with sales.
Accounts payable?
Accounts payable, thank you very much. Why?
Because that's related to all of your the amount of cash that you would receive off of sales that you just haven't received yet.
Well, that's AR, but your point is a good point. So accounts payable is the only item that varies with sales, because if we have to go out and buy the product that we then convert into the actual saleable product, right? So that's the money that we owe to our suppliers. Okay, so as sales go up, we've got to buy more stuff so that we can convert all that stuff into the product that we're going to sell. So very, very good observation. Accounts payable is the only item on the right-hand side of the balance sheet, okay, that is going to move up by that percentage of sales. Okay, so if sales go up by 15%, we're going to move accounts payable up by 15%. Notes payable, that deals with debt financing. Long-term debt, that deals with long-term debt financing. Common stock, equity financing. Retained earnings depends upon your management decision around what kind of dividend payout policy you have. So really, the only item tied directly to sales on the right-hand side of the balance sheet is accounts payable. Very good observation. Okay. So what I'd like to do now is go through this example. All right, and I've already built it out. But what I'd like for you to do is on your own, okay, take the next 5 minutes, all right? And what I'd like for you to do is get 2018 built, okay? So I'd like for you to build the 2018 income statement, okay? And I'd like for you to build the 2018 balance sheet based upon the data that you see here. Okay, so I'm going to give you guys 5 minutes to work in Excel to get this data listed here put into an income statement format and a balance sheet format. Okay, and then we'll come back and revisit how we go about building the growth projections in Excel. Okay, I've already got it done in Excel. I want you to get it done, so when we go to my Excel, you can compare yours to mine to see where the holes might be. Okay, so let's go for 5 minutes. And if you have any questions as you're going through the build out here, feel free to ask. Either hit the chat room or just speak up. Okay, I'm still here. And we're dealing with 2018 owner's equity OE. All right, don't worry about this APIC. This is something that we call additional paid in capital. Just refer to it as common stock. Okay, we're not going to deal with APIC. Okay, everybody at least have the income statement built for 2018? All right, let's head on over to Excel here. And let's look at Tasha's little business. Okay, so income statement for Tasha's business here, all right, is listed right here, right? So she had $5,000 in sales, she had $3,500 in costs, therefore her earnings before taxes was $1,500. There was no depreciation, there was no interest, so we can go right from sales minus costs directly down to EBT, which is how we're going to calculate taxes. It tells us that our tax rate was 21%. So therefore our taxes are 21% of the 1,500 for a net income of 1185. Okay. So that was the 2018 income statement. Right. It also tells us that there's a payout ratio of 40%. All right. And based upon your readings within the text, the payout ratio, right, is the ratio of net income that gets paid out to dividends. Okay. So if the payout ratio is 40%, that means that 40% of the net income gets paid out to shareholders. Therefore, 40% of 1185, they paid $474 to shareholders, which left $711 of the net income to be added to retained earnings for 2018. Everybody crystal on that? Okay. Balance sheet for 2018 tells us that we had $500 in cash, $2,000 in AR, $4,000 in inventory, so our total current assets are $6,500. Told us that we had $5,000 in NFA for total assets in 2018 of $11,500. Okay. We know that we've got $900 in accounts payable, $2,500 in notes payable, $3,000 in long-term debt. We've got total liabilities of $6,400. It tells us what our common stock and retained earnings are. So $5,100 in equity, liabilities plus equity, $11,500, and we are balanced. Okay. So 2018, we've just taken the data that were given from Tasha, okay, and we've put it into our two financial statements. Okay. And yes, everything balances, and we have a net income, and we know what our dividend payout ratio is. Did everybody get that?
Can you scroll down to the equity? Oh.
Okay, so it tells us that we had 2018 owner equity, which was $2,000 of common stock and $3,100 of retained earnings. So our total equity was $5,100. And when we add the $5,100 to the $6,400, we know that we balance at $11,500. Okay, so for 2018, it gave us all the data. There wasn't anything that we had to figure out. It already told us everything.
When you got the dividends paid out, where you took 40% times what?
Times your net income.
Okay.
Right? Because net income is split between dividends or retained earnings. Okay.
Okay.
So if our payout ratio, which is the relationship between the dollars of dividends. So if I were to take the dollars of dividends that I paid out and I divided it by the net income, all right, it's 40%. So the payout ratio tells you what percentage of net income goes to dividends, right? And the retention ratio is what percentage of net income gets added to retained earnings, right? And the two of those percentages have to equal 100% because we're splitting up all of the net income into one of those two buckets.
Okay, yeah, I get it now. Thank you.
Make sense? Cool.
Yep.
Good. Good question. Okay, so we've got 2018 done. Okay, now you'll see 2019 numbers in here. Okay, but those are not the 2019 numbers yet because I haven't put in the growth rate associated with Tasha. But what I wanted to show you was just how to set things up, because this is going to be very similar to, you know, what you're going to be doing over the next couple of weeks and on the check-in exam coming up on Thursday, where you're going to have to develop that pro forma estimate for the subsequent year's worth of business. So this is how I like to set things up. I have my assumptions table. Okay, that way, you know, if I tell you that the tax rate is something other than 21%, you've already got everything linked back to these assumptions that you're going to be provided. But for this case, what does it tell us about Tasha's projection for sales for 2019? What does it tell us that she's projecting for a sales growth in 2019?
Nothing?
Check out the third red bullet on the PowerPoint. Tells us that her 2019 projection is a 10% sales growth. Right? Everybody see that? I know I'm asking you to go back and forth between Excel and PowerPoint. Hold on. Here. See that right there? It tells you, it gives you the growth rate. Okay? So when we go to Excel, I can plug in a 10% growth rate and it changes my sales forecast. So when I look at my sales, okay, with my growth rate, right, I did 5,000 in 2018. I'm projecting that I'm going to do 10% more than I did last year. Therefore, my full year projection of sales for Tasha's Toy Emporium is now 5,500. Okay? We're growing our business by 10% over what we did the prior year. Okay? And since things move in relation to sales, our costs will also go up by that same 10%. EBT went up by 10%, okay, because there was no impact of depreciation or interest paid. So there's a relationship that continues, 10% increase. Right? We have our taxes, right? If you're gonna make a mistake, on the check-in exam, taxes is going to be one of the areas that you're gonna make a mistake on, because you're going to just make the assumption that it moves up with sales, and it does not. So do not fall trap to that. Make sure you do the actual tax calculation. EBT times the tax rate, okay? It just so happens that because there was no depreciation or interest impact, that it also moved up by 15 or 10%, all right? That's just coincidence. Do the tax calculation by itself. 21, the tax rate times EBT. Do not just move it up by the growth rate. And then finally, net income. All right, EBT minus taxes is net income. Okay. So in this example, because there was no impact from depreciation or interest, everything did happen to move up by 10%. Okay, which was the sales growth. All right. Now, based upon our dividend payout policy, it says Tasha told us that it's going to be the same payout ratio for 2019. She tells us that within the case right here, same payout ratio. Okay, so we have the payout ratio of 40%. So we're now going to pay 40% of our net income to shareholders in the form of a dividend. The dividends that we pay in 2019 that we're forecasting is net income times the payout ratio. Okay? And therefore, whatever's left over flows to retained earnings. Okay? Does everybody understand how we moved from 2018 to 2019? And 2019 E means 2019 estimate. Okay, I'll take that as everybody understands. All right, now we move to the balance sheet. Okay, and we said that everything on the left-hand side of the balance sheet is going to vary as the percentage of sales. So if sales growth is 10%, then everything in our pro forma estimate for 2019 needs to vary by the same growth rate. So cash went up by 10%, AR went up by 10%, inventory went up by 10%, PP&E went up by 10%. Okay, so therefore our total assets went up by 10%. Right? Now, on the right-hand side, okay, on the right-hand side, Accounts payable goes up by 10%. Notes payable stays the same. Long-term debt stays the same, because remember, those are not varied with sales. Common stock stays the same, doesn't vary with sales. But somebody please tell me why retained earnings went up as a projection, and how much it went up by, and why that number is significant. You can still see we're out of balance, so we're going to have to do something. But why is our initial projection for 2019 retained earnings, why did it go up?
Is it because the net income went up and you take 40% of the net income and we increase that by 40%?
Okay.
Then your addition to retained earnings goes up because of that as well.
100% accurate. Very good. Good job, Nick. Okay. The total difference between the 2019 estimate and the 2018 actuals is 782. And that number ought to look real familiar because, as Nick just said, that is the forecast for addition to retained earnings based upon our income statement and our 40% payout ratio. So the 60% retention ratio, okay, 1 minus the payout, gave us $782 that should flow to retained earnings in our 2019 estimate, and that's exactly what has happened. Okay, so we took care of that piece of the puzzle. Now, we're still out of balance, right? Everybody see that? So our 2019 assets don't equal our 2019 liabilities and equity, right? So we call this difference the external financing needed, or EFN, okay? And it is the difference between the projected assets and the projected liabilities and equity, okay? It gives management an idea of how much additional financing is required in order to make the balance sheet work. So in this case, there's $278 of external financing that Tasha requires in order to force the balance. Now, what options does Tasha have? Okay, and this is a question to you guys. What options does Tasha have on the right-hand side of the balance sheet in order to force the balance? What can she do? What levers does she have to find $278 somewhere in the world?
You can finance it through the bank or shareholders.
Okay, very good. So she could go to the bank and she could ask for more money, which would take this up, right? So if she did the entire thing, if she took the entire 278 and added it to long-term debt, this would be 3278. And then all of a sudden now you're balanced, right? So she could do that. She could go to the bank and take out a loan, put that into long-term debt, and then long-term debt just became your plug. What else could she do? Equity. Good, Taryn. She could issue more stock into the marketplace. Okay, she could go out and issue new shares into the marketplace equivalent to the financing that she needed, and this would go to 2278, and we're in balance. Okay. What's the third thing that she could do? And I don't mean notes payable. What's the third thing that she could do? Let's see if you guys can put all the pieces together here. What's the third thing that she could do to get $278 more on the right side of the balance sheet? How did we get this retained earnings number?
Could you add it to your retained earnings?
Okay, so if you're going to add $278 to this retained earnings number, what management decision do you have to make in order to get $278 more right there in retained earnings? Subtract from dividends. Good job, Grace. So if we take 278 from dividends, bam, we added 278 to retained earnings, and now we're in balance. See the flow? So this is how the pro formas get developed. We have our actuals. So we were given the actual data for 2018. We build the income statement. We build the balance sheet. Okay. We're given some assumptions, tax rates, growth rates, payout ratios. And by definition, the retention ratio is whatever's left over. So 1 minus the payout ratio is the retention ratio. Okay. And then we start building the estimate for the next year. We increased our sales by 10%. Our costs went up by 10%. EBT is sales minus cost. We calculated our taxes using our tax rate on EBT. And we calculated net income, EBT minus taxes. Based upon the data that we were given, we were told that the payout ratio was going to remain constant at 40%. So we took 40% times our net income to tell us what our dividends paid were going to be projected at. And then whatever was left over of the net income went to retained earnings. Income statement done. Balance sheet. We took the entire asset side of the balance sheet up by the growth rate, so everything went up by 10%. On the right-hand side, the only thing we varied by growth rate was accounts payable, because that's the only real item on the right-hand side that relates to growth in sales. Kept notes payable the same, kept long-term debt the same, kept common stock the same. And then the only thing we did to retained earnings was we took what we started with and we added what we projected to flow into it. Okay? And then we just did all the math. And then we came out and we said, all right, 2018 naturally balances, but for 2019, our projection, like we're off, like we're not balanced, which is normal. So what's the difference? How much more financing do I need, okay, in order to force the balance? Okay. And that was the difference between our asset projection and our liabilities projection. We had to find external financing in the order of $278 in order to force the balance. Okay. So we said we could either take on more long-term debt, we could either issue more stock into the marketplace, or we could change our dividend policy to pay out less in dividends so that more flows to retained earnings and we make up that difference through retained earnings. Okay? Everybody follow the flow of that? Okay. All right. Back to PowerPoint. All right, so we just finished this example here. All right, we talked about the plug variable. Okay, and we could also borrow short-term. I didn't mention that, but yes, we could take out more short-term loans if we knew that it was just going to be a short-term financing needed. So my apologies for not bringing that one up too. Okay. So one of the things that we might face in the real world is that we've got enough fixed assets on the books that we're not operating at full capacity. Okay, so in the case of Tasha, let's say that she's operating at 80% capacity, meaning she's got 20% excess capacity in her production line, okay, that she's not using right now. She's only using 80% of what's available to her. Okay. So what do our sales look like if we were operating at full capacity? Well, 2018, we did $5,000 in sales, right? So at 80% delivered the 5,000, right? So at full capacity, 5,000 divided by 0.8 tells us that if we were operating at 100% capacity, okay, then we don't need to add fixed assets until we get to the 100% capacity, right? So in the case of Tasha, and we took our sales up by 10% to 5,500 as a projection for 2019, okay, we're only operating at 88%. We're still well below the 100% capacity. So at that point, do we actually need to increase the fixed assets by 10%? If our assets are already underutilized and our growth rate of 10% takes us from an 80% capacity utilization to an 88% capacity utilization, we're still below 100. We don't necessarily have to add to our fixed assets. Okay, so again, management decision as it relates to production capacity utilization. So if in the case of Tasha, right, she's continuing to operate below her 6,250 100% capacity utilization, then we don't need to add new fixed assets. And when we change this to simply be what it was for last year at 5,000, okay, now instead of having money that we have to go out and find, now it flips in our external financing. We have more than we need. Okay, we have more than we need for 2019 because we didn't have to go buy new fixed assets because we were already underutilized. Okay, and so now what's the conversation, right? Well, we could pay down short-term debt. We could pay down some long-term debt. We could buy back some shares. We could pay more money out in dividends, flow less to retained earnings. It's the opposite of what we just talked about, right? Any questions about that? I'll tell you that for the check-in exam on Thursday, your assumption will be they're running at full capacity. Okay, so you're going to vary the fixed assets by whatever the growth rate is. On your midterm, though, you'll probably have a little capacity utilization question that you're going to want to think through. Okay. So again, when we've got excess financing, the conversation just goes the other way. Do we pay down debt or do we pay out more in dividends, period? Or do we increase the cash account? Okay, so this is all fine and good, how we go about growing our business from projections. But what we want to truly figure out is whether or not, based upon the financing decisions that we've already made in terms of debt versus equity, all right, at the growth level that we're projecting, so the internal financing, meaning the retained earnings component, okay, might exceed the required investment in assets, right? We might need to go out and get more money to sustain the growth that we're trying to achieve. So as the growth rate of the firm continues to increase, it's rare that firms can sustain that growth simply using the internal financing available to them. And they have to then go access the capital markets, either in the form of issuing new stock or taking on more debt okay, in order to get that additional financing that they need to grow. So how we go about examining the relationship between growth and the external financing is a really important tool when we think about planning for the future. Good. I always forget. Sometimes I don't remember to turn the recordings back on, and it freaks me out, but we did. Okay. So when we think about, come on. Okay. When we think about internal growth, essentially, how much are we capable of growing simply with what we've got with the assets that we have? Okay. We have this concept called the IGR, or the internal growth rate, telling us how much growth can we reasonably expect, okay, using the retained earnings as our only source of financing, okay? Not taking on new debt, that's a different animal, we'll see on the next slide, but just using our own stuff, our retained earnings, how much can we grow? So when we look at the return on assets for Tasha, okay, net income divided by total assets, we can see that Tasha's Emporium has a return on assets of 10.3%, okay? 1185 of net income, 11,500 of total assets. So we are generating a 10.3% return on the assets that we have. Then we have this variable called B, right? The retention ratio. Right? It's how much of our net income are we keeping for ourselves on a percentage basis. So in the case of Tasha, right, she told us that our dividend payout ratio was 40%. Therefore, by definition, the retention ratio is 60%. Okay, 60%. Because if we're paying 40% out and we know we can only have two choices to make, that means we have to be keeping 60% for ourselves. So the formula for internal growth rate is we take the ROA times the retention ratio, and we divide that by 1 minus the product of ROA times the retention ratio. And when we do that for Tasha, we can see that using only retained earnings, okay, only retained earnings as our source of financing, right, we can reasonably expect to have a consistent growth of around 6 to 7%, 6.6%. Okay. Now, we have the sustainable growth rate, right? This tells us how much can we reasonably expect to grow, right? Using the funds that we generate internally, as well as going out into the capital markets to secure financing for the business under a constant debt ratio, okay? And so that means, you know, debt to equity, total debt to total equity. So in this case, we're looking at return on equity, not return on assets, but return on equity. Okay, so return on equity for Tasha was the 1,185 of net income, right? Divided by the total equity of 5,100. So we have a return on equity of 23.2%. B is still 60%, okay, retention ratio. So our sustainable growth rate is actually 16.2%. Okay, so what does that mean as it relates to Tasha? Okay, so she had a growth rate projection of 10%, right? So if we think about the IGR for Tasha of 6.6%, what she can do on her own with retained earnings, and her SGR of 16.2%, that 10% falls somewhere in between. Okay, so Tasha cannot reasonably expect to sustain a 10% growth simply by using her retained earnings as her only source of financing, because her 10% projection is higher than the internal growth rate. However, accessing the capital markets and keeping a constant debt ratio, she can continue to reasonably expect to achieve that 10% growth, because that 10% growth is less than the 16.2% sustainable growth rate. Does that make sense? If the forecasted growth rate is less than the IGR, then it's not feasible to sustain that growth long term. You might be able to do it for 1 year, okay? But from a forecasting standpoint, it's not feasible to achieve that long term, okay? If the forecast growth rate is between the IGR and the SGR, then yes, you can reasonably sustain that level of growth using a constant debt to equity ratio while accessing the capital markets. If your projected growth rate exceeds the SGR, then it's not sustainable for the long term. Again, you might be able to do it for 1 year, but it's not a sustainable, not a viable assumption for long-term growth. Is that clear to everybody? Okay. So what are some of the determinants of growth, right? Well, we talked about some of them last week within the DuPont identity, and here they are again. Profit margin. How well are we controlling our costs? How is our operating efficiency doing? Total asset turnover. How many times a year are our assets delivering revenue for the firm? Financial leverage. What is the equity multiplier for our firm? How much debt are we taking on in order to support the growth that we're experiencing? And then finally, dividend policy, okay? Are we going to pay money to our shareholders, or are we going to keep everything for ourselves, plow to retain earnings, and then grow our business internally so that we don't have to access the debt markets to finance our growth, okay? All management decisions and all determinants of the eventual growth for a firm. So when we think about some important things that we ought to be asking ourselves as we go through this budgeting process, right? We're dealing with accounting numbers, right? And that's fine. Those are the numbers that we start with, right? But that doesn't mean that the accounting numbers are going to work with some of the assumptions that we're going to be making for the next 3, 5, 10 years when it comes to the budgeting process. How's the timing? How are the economic situations in the marketplace that we participate in right now? Are we in the bottom of a business cycle? Are we at the top of a business cycle? Those things will impact what those streams of cash flow look like over the period of time that we're forecasting on. Right? Do we have any inconsistencies in our goals? Right? After we've gone through this planning process, are there things that we find that give us cause for pause, that are inconsistent with one another? Right? And then finally, the third bullet point, if we do this, if we implement this strategic plan, are we maximizing shareholder wealth? Again, from the second lecture that we had, that is first and foremost what needs to be in the forefront of the financial manager's mind. Are the decisions that I am making maximizing owner wealth? And if they are, great. If they're not, then you need to pivot and rethink and rework the forecast, right? Plain and simple. Okay.